Well, as the markets continue to fluctuate, as the job market continues to have some consistency, actually, and even despite that, there's plenty of questions about our state of economics and the business community all throughout the Great Lakes State. And here to help us clear some of that confusion up is Michael Greiner, an assistant professor of management at the Oakland University School of Business Administration. Michael, thanks for joining us today.
Great to be here again. Thanks, Tyler.
Appreciate having you on. So let's start off. Probably the big news this week was the conference in Jackson Hole, Wyoming, that included the chair of the Federal Reserve, Jerome Powell, giving a speech regarding the Fed's continued response to inflation. Can you tell us about and give us a little bit of a summary of what the chairman of the Fed had to say in Jackson Hole and the way that that's already impacting our economy?
Sure. Yeah, this is actually an annual conference that the Fed holds, although obviously they didn't hold it for the last couple of years for obvious reasons. But the Fed chair is kind of he gives a speech at this conference, and it's generally perceived as an important opportunity for everybody who's watching the markets to kind of try to understand what the Fed is doing. And interestingly enough, in his speech, he gave some very clear direction, which is kind of unusual for the Fed, actually. Typically, they talk in what's called sometimes Fed speak, which means that they use a lot of words to say basically nothing. And there's a reason for that. The reason is that they want to keep their options open. They want to make sure that if circumstances change, they're not kind of bound in by the expectations of the market to do a certain thing, even though it might not be in the kind of in the best interest of the economy at the time. In this case, though, Chairman Powell tried to send a very strong message directly to the markets. And what the message was is we are not letting up on the accelerator here. We are not going to reduce our effort to increase interest rates and to get inflation under control. Because frankly, I think that's what the markets have been seeing. They've been expecting that, oh, we're starting to get some good information here. Things are looking a little more positive. So that should indicate then that the Fed might not be as serious about continuing with the aggressive approach that they've been taking toward inflation. And the message that Powell sent was very clear. He said, nope, we are going forward. We are going to tame inflation. We're going to get it down to the 2% rate, which is what we typically are looking for. Because there'd also been some talk about, well, maybe they won't push it all the way down to 2%. Maybe they'll just push it down to 4%. That was a message that the Fed chair sent loud and clear. Nope, we're not giving up on this. So for people who are happy to see the Fed serious about fighting inflation, that's good news. For people, though, who are concerned that it could mean a bit of a slowdown in the economy, it's something that's a little bit worrying. So we'll kind of see how this plays out.
We've already seen a bit of a reaction in the stock market. The stock market metrics were down almost immediately after that speech, continued on throughout the end of last week, the middle part of this week after that speech was made. And so with the market's reaction to that speech, where do you believe that the business community, particularly those that are really directing the markets, are looking at the future of our economy, given this directive from the Federal Reserve?
Well, I think you raise a couple of interesting questions there. The first one is the relationship that the stock market has to the economy overall, which in some respects is overstated, I think. You have to remember, I mean, fundamentally what the stock market is about is that they're buying interest in these businesses. And the risk is that they're going to lose money if the business goes out of business. And so essentially what the stock market should represent in its purest sense is a bet on the likelihood that this business will succeed relative to it going out of business. Because if it goes out of business, the last people to be paid are the owners, the shareholders. Essentially that's the risk where they might lose all of their investment. So, but that ends up really being kind of a long-term perspective on things. Does concern over the overall economy impact the stock market? Of course it does, because if the economy goes south, you're going to see more businesses go out of business than you might see otherwise. So that'll kind of increase the risk there and might push down the stock market. But I think the dynamic that you see a lot of the time here, especially when people are watching the stock market closely, is more of a short-term impact. It's almost you see a certain amount of gambling going on in the stock market. And just as an aside, one of the exercises that I think every economics graduate student has to go through, I certainly had to go through it when I was in grad school, is you do an analysis of the stock market using statistical tools that are basically the kinds of things that economists use. And what that analysis clearly shows is that the stock market is engaged in what's called a random walk, which means you literally cannot predict what's going to happen in it. It's completely at random, that all the information that's out there is literally boiled into whatever the current price is in the stock market. So if somebody is saying, I'm going to invest here or I'm going to invest there, there's a certain amount of gambling going on, essentially. And what they're trying to do then is kind of look at kind of these psychological figures, like what would make somebody bet on this stock versus that stock. A lot of that has to do with certain companies being able to tell a good story. Like I would argue that Tesla, for example, is way overvalued. But hey, everybody thinks Elon Musk is interesting and he tells a good story, so why not invest in him, right? On the other hand, what we see also is kind of a competition among investments. So, for example, when the Fed chair is saying we're going to raise interest rates, what does that mean to the stock market? Well, it means, on the one hand, is there a slightly elevated risk that certain businesses might go out of business? Yes. But the bigger issue, I think, is that it means that bonds are going to pay a higher rate of interest. So what a lot of what you're seeing happening are investors moving from stocks as their main investment over to bonds as their main investment. So when you see the drop in the stock market, a lot of the time it's just people adjusting where they're putting their money. Right now, bonds probably are looking like a more attractive investment, considering the fact that the Fed's going to keep raising interest rates. Higher interest rates mean bonds pay better than stocks.
I think one of the great fears of the situation we're in with inflation in the US is that fear of going into another recession. And I think it's even more of a fear because of the last recession we went through being the Great Recession. How much of a factor do these decisions from the Fed play into the potential for a recession in the United States in the near future?
Well, that right there, my friend, is the $64,000 question, or $64 trillion question, I guess, in some ways, because of the fact that that's what the Fed is trying to avoid. In my view, actually, the Fed did a fantastic job responding to the Great Recession of 2008 and 2009. Then you had Ben Bernanke as the chair, and he was basically a scholar of the Great Depression. And he tried to use the lessons that could be learned from what had happened in the Great Depression to address the response that the Fed had to the Great Recession. Now, that being said, it was a terrible, terrible recession. I was actually working as a bankruptcy attorney at the time, and I can tell you that the economic impact it had on families and businesses across the state and across this country was severe. And I think just about everybody experienced that. So you're right. I mean, people are concerned about that. But Americans, and this is no criticism because I'm one too, and I do it too. We're notoriously short-sighted. And so on the one hand, we do have this kind of memory, this collective memory of how bad the Great Recession was. And especially younger people were dramatically impacted by it, where they came out into job markets that really did not provide them many of the opportunities that you saw some of the older people have. And so that's kind of been something that's weighed them down in their careers. But overall, people really right now are more concerned about inflation. And is that what they should be more concerned about? Well, I mean, we could debate that, and that's probably a debate for another day. But the bottom line is that what the Fed is trying to do is they're trying to engineer what's called a soft landing, where their goal is, hey, we don't want to have a serious recession to get this inflation under control. But what we want to do is kind of slow the economy just enough that people start charging less for the goods, and there's kind of more competition on what we call the supply side, where people are selling things, so that companies aren't able to raise their prices so much without fear that consumers just aren't going to buy them then. And so that's what the Fed's trying to do. Frankly, the Fed has had some success in the past on that. The Great Recession of 2008 was kind of a once in a lifetime thing with a financial crisis that caused it. Again, we could some other day go into a long discussion over what caused that. But the bottom line is that's not what we're seeing right now. What we're seeing right now, though, is more akin to what you saw back in the early 1980s, when the Fed stepped in and tried to tame the inflation that we had of the late 1970s. And then, though, the idea of inflation, what they call inflation expectations, had kind of gotten baked into culture. People just expected there'd be more inflation, so they wanted higher raises. They expected they'd be paying more. So that was the case, and that's what right now Jerome Powell is trying to avoid. And again, this is one of the messages he sent very clearly in his speech, which is we don't want those expectations to get baked in. So we're going to move very aggressively, very early. Waiting longer only makes things worse. And that's, again, part of the problem that we saw in the early 1980s, which is they took a long time to finally start addressing this problem. When they did, it required a severe recession to get inflation under control. And the hope is that by moving quickly now and aggressively, we can get it under control without dealing with the kind of job losses that you had, say, in the early 1980s.
Yet to paraphrase Chairman Powell, a little bit of pain now could prevent a lot of pain down the road. We're joined by Michael Greiner, Assistant Professor of Management from Oakland University School of Business Administration. Michael, another minute with you before we say goodbye. Anything else or any lasting information on this that we haven't discussed today that you would like our audience to know?
Yeah, one thing that's interesting is we did get some jobs figures this morning. That's always interesting. And, we economists were always sitting on the edges of our seat watching that. Everybody has predictions as to what it was. And I think the interesting thing about this jobs report is it was surprisingly non-remarkable, which is a good thing, I think, as far as most people are concerned. There were fears that if it were a really high jobs report like we had last month, when we had hiring in the range of 526,000 new jobs, that would have been the thing that would have driven the Fed to increase interest rates a lot more. On the other hand, if we saw a big drop in jobs, then that would be an indication that maybe the United States is starting to slip into recession, and we need to be worried about that. Well, as it turns out, we got a jobs report of 315,000 new jobs last month, which is a pretty good figure, actually, overall. The labor force participation is up, which is good. The unemployment rate ticked up a little bit, which sounds bad, but in the context of the labor force participation rate having gone up, that's not such a bad thing. And at that figure, it means that people are still hiring. There are still jobs out there. But it's not looking like we're going into recession, and it's not going to be high enough that it's going to be the type of thing that the Fed needs to really put on the accelerator. So that's good news, I think, as far as everyone's concerned.
Something we'll keep a look at in the future as a way of telling where our economy is going, and, of course, as a metric for where we're at. Michael, appreciate your time.
Happy to be here, Tyler. Have a good weekend.